Joining us now is 314 co-founder and strategist Warren Pies. Warren, good to see you. So going back to 1950, you say there have been 23 years where the S&P was up 10% or more in the first half, like this year. More than 80% of the time, it was even higher in the second half, right?
Yeah, thank you for having me, John. That's exactly right. I think to understand the second half of the year, you have to kind of shed some of these intuitions that aren't correct about the market. And one of those is that if you have a strong first half, you should give some of that back in the second half. And to really think about what's going on, in our view, mechanically in the market right now, is you have to go back to the beginning of the year. 2023 was a tough year for the consensus strategist community. And so they all were kind of moving into this normal playbook, and that involved a presidential election year. And they said that playbook says weak first half, strong second half. So this immediate first half rally, which we were calling for, has really caught a lot of people off sides. And there's, quite frankly, just a lot of investors that are behind the eight ball. And when you get to the midpoint of a year like this, what history tells us is that there's basically a catch up, a chase of the rally through the second half into year end. And I would say that's the most likely outcome. As you said, there's been 23 years where we're up 10%, more than 10% in the first half. 19 out of those 23 years, you continue higher in the second half. And if you compare them to all other years in the market, it's a significantly better second half. So it's a little bit unintuitive, but when you think about the chase and the pressure that the calendar puts on asset management community, that's what I think is at work here going into H2.
At the same time, this rally in equities has been historically narrow, so it's possible that a lot of stocks could do pretty well in the second half, but some big ones could not do well, and that could ruin the overall effect, right?
Yeah, I mean, I think that that's been kind of a concern or a thought that a lot of people have been caught up in. If you go back to the beginning of last year, there was this mega cap tech divergence. It happened again in the fall. It happened earlier in Q1 of this year. Each time this has happened, there's been a whole bunch of concerns, like, will the big cap tech stocks fade? Will the rest of the market fail to catch up? And really what's happened is every time we've had narrow breadth, the rest of the market, it hasn't fully caught up to big cap tech, but it's gotten dragged along for the ride. And that's kind of what I would anticipate to happen this time around too. It's something we're watching. Equal weight S&P 500 hasn't made a new high, confirming the S&P 500's new high back on May 15th. So you have like 90 days usually historically for that to happen. But in my opinion, the base case is a broadening out, and it might not mean that the bottom 493 surpassed the Mag 7, but I think they're going to get dragged along for this H2 rally for sure.
So in your opinion, how will we really know when we're entering a stock picker's market? Because it seems like we haven't been in one in quite a while. If you just sort of stuck with the S&P 500 for a while now, you've been okay.
The truth is, it's hard to beat the market, but this is a stock picker's market. I mean, whether people want to admit it or not, maybe you're just not a great stock picker. Our main system, it's a quality-based system, and we pick 20 stocks every month and beaten the market for 3 straight years. And if you look at correlations in the market, we are pretty low right now. We take the correlation of every stock in the S&P 500 to the index, and it's on the very low side historically. So if not now, when? When are you? If you're not a good stock picker now, then maybe you're just not a good stock picker is what I'd say. And so I think that it's important to understand the dynamics that are at play in this broadening. And there's a time and a place for value. There's a time and a place for small caps. I don't think that that this is the time or the place, though, for either of those spots.